Infinite banking is a concept that teaches you how to use the cash value in a whole life insurance policy as a financing tool. After more than 10 years of helping high net worth families grow millions using life insurance, I've learned how to scale wealth tax-free. So here's the 4-step blueprint to setting up infinite banking the right way. But first, you need to know what infinite banking actually is and why it isn't too good to be true. Pretend for a moment that you have a bar of gold that's worth $100,000. But as time passes, you know that gold is going to be worth millions of dollars. Years later, you need $500,000 for an investment you're looking at, but you don't have the cash on hand. Now, your gold at the time is worth $1 million, and you could sell it to get the $500,000, but you don't want to do that because you know the gold will just keep going up in value over time. So instead of selling the gold, you pledge it as collateral to get a loan from the bank. That's what infinite banking does. Infinite banking is a concept that teaches you how to use the cash value in a whole life insurance policy as a financing tool. The cash value in this example is your gold bar. Whole life insurance is one of the safest places you can put your money. It's guaranteed to continue to go up in value, and you can leverage it without ever liquidating it. And the infinite part of the concept means two things. First, when you borrow against a whole life insurance policy, your cash value keeps on compounding, the entire amount, which includes the amount that you borrowed. Second, when you die, a tax-free death benefit is paid to your beneficiaries. What attracts people to infinite banking is that it's a way to get out of having to work with traditional banks and dealing with paperwork, strict loan terms, paying huge amounts of loan interest on mortgages, car loans, business loans, and having to wait 3 months for a loan to be approved when it should only take a day or two. There are 3 things that often interest people in learning more about whole life insurance, and they all have to do with the cash value. The cash value is guaranteed to grow safely. You can access it anytime without approval, and it keeps compounding when you access it, and you can access it tax-free, provided we follow IRS rules. Let's move on to step 1, understanding the mechanism. Once you have cash value, you can access that cash value anytime you want through a policy loan. When you start a policy, you can access the money via a loan as early as 10 business days after starting your policy, and you can borrow up to 95% of whatever your cash value is. Now, it is called a policy loan, but you don't have any requirement to qualify for the loan. There's no payment terms, and you have complete control of how and when you pay it back. When it comes to paying your loan back, you could go into your online portal, throw money at the balance, or you could set up automatic payments with most companies. And whenever you make a payment toward your loan principal, what you'll notice is the next day, it'll show up in cash value. So here's an example of how policy loans work. Let's pretend that you've got cash value of $100,000, right? And you want to take a loan of $50,000. Okay, so you had $100K and you borrowed $50K. Here's the good part. You're not working with a bank. So what that means is you can pay it all next month, or over 10 years, or over 30 years. It's really however you want. But why people like this from a number standpoint is when you take that $50,000 loan, you are still earning interest on the full $100,000. It's uninterrupted compounding. A question that always comes up here is, how does the insurance company do this? Well, how it works is that when you take a loan against your policy, it's always based on whatever you have in cash value. But when you borrow, you're technically not taking money from your cash value. The insurance company is giving you a loan from what's called its general account, and then they are holding your cash value as collateral. That's the technical process as far as how it works. The insurance company continues to credit you interest because, 1, they do charge interest on the loan, but 2, what's their biggest liability as a life insurance company? It's in the name. Pay the life insurance out, the death benefit. So when you borrow against your policy, you will see your death benefit reduced by the amount that you borrow. So where I would use infinite banking is if I did not want to liquidate other investments to take advantage of opportunities. Think of it this way. If you have money growing in the market, real estate, or cash value in a life insurance policy, and you need capital for something time sensitive, you can access the money in your whole life insurance policy fast without stopping any of the growth. Step number 2, avoid these 4 traps. Number 1, the belief that you can borrow against the death benefit. Since I started my business, people have always called our office and said, hey, I'd like to start a policy with $100 per month, get a $1 million life insurance policy, and then immediately take a $500,000 loan against the death benefit. And they think they can do that because they saw a video somewhere or read an article that made them believe they could borrow against the death benefit. It doesn't work like that. The amount of money that you can borrow is always based on your cash value. Trap number 2, not understanding the dividend rates. When someone says your whole life insurance policy has a 6% dividend rate, know that that is a gross rate applied to your policy after the cost of insurance is deducted. To see the net results, I would request either the annual rate of return or the internal rate of return. Number 3, looking at a hypothetical illustration and expecting those results to come true. The biggest form of buyer's remorse that occurs among people who buy whole life insurance is that they look at a projection, which is an illustration. The numbers look fantastic, but then the actual results end up being much, much less. To avoid this trap, I would first ask to see the guaranteed values. That will set expectations as low as you could possibly set them. But then I would ask to see proof of performance from the insurance company that your agent is showing you. Trap number 4. The policy is set up with a high base premium that generates a massive commission for the agent. Here's how you could spot this and avoid it. Let's assume you pay $10,000 per year. So you get a life insurance policy and you say, okay, I'm going to fund $10K per year. Here's you, and here's your money. Good. So in the first option, or the first illustration you're presented, when you look at the first year, your cash value is 0. Seem like a good deal? It's not. Let's assume you look at a second option and your cash value in the first year is $6,000. You say, I'm not putting money there. And then finally, you look at a third option where your cash value in the first year is $9,000. All with the same company and all with the same policy. And here you just got different options. So we've got option A, B, and C. Which option do you want? It's kind of a no-brainer, right? Option C. Which option do you think I want to sell you? Here is what the agent makes. With option A, in the first year alone, the agent might make $10,000. With option B, they'll make about $4,000. And with option C, they'll make about $1,000. Might be $1,100, depends again on the company and product. But assuming that we take the same company, same product, we just design the policies differently, you can see the incentive for the agent. But you also see how your money is impacted via the cash value. The key item to be aware of here, awareness is one of my favorite words, is to know where is your money going. Because your money can go toward 2 areas, the base premium or the PUA rider. With option A, all of your money went toward the base premium. With option C, the base premium, we'll just call that base, is $1,000. And the PUA, which stands for paid up additions, is $9,000. And you can choose where your money goes. So here's what I would do when you meet with your agent to get a policy. The first question I would ask is, what's the most cash value I can have upfront on day one? Question number 2, where is my money going? Question number 3, is the base premium set at the absolute minimum that this insurance company will allow? All companies have different rules and different limits. And question number 4, can you show me an actual policy that is 10 or 20 years old? If an agent ever gets defensive in a meeting, or they try to use emotion to sway someone in one direction or another, it's usually because that person is asking questions that if the agent answers directly, it's going to result in the agent being paid a lower commission. I've seen that happen so many times over the years, especially with technical folks and engineers that know how to engineer that policy correctly. Step number 3, choose the right company. I recommend these companies to everyone, regardless if they work with my company or not. These companies are Mass Mutual, Guardian, New York Life, and Northwestern Mutual. They have the best financial strength and safety ratings, and they are massive in terms of size. But the big selling point for me is I've seen consistent proof of performance from them year after year when it comes to tracking the actual results of whole life insurance policy. With those companies, I feel more comfortable because I don't have to worry about them under-delivering compared to what was shown on the illustration, and then the client gets upset, but they get upset with me. I don't want that. It's their money we're dealing with here. But what I find interesting is when it comes to the topic of infinite banking, a lot of agents don't like using these companies. And I hear things like, those companies don't support infinite banking, or Mass Mutual and Northwestern Mutual don't allow it at all. If you have a policy with any life insurance company, you can do whatever you want with it per the contract language. And if you compare the contract language in a whole life insurance policy with 100 different companies, it is going to be so similar. So the challenge with this is that as an agent, I'm literally incentivized to sell you a product with a company that I can't get any proof of performance from, to the degree that I've gotten it from the major mutuals. So here's what I would do if I'm looking at a whole life insurance policy. When you speak with your agent, ask, what company or companies do you recommend and why? If it's not one of the major mutual companies, I would ask, can I see some proof of performance? I really want to see if this company delivers long term. And then I would also ask to see what are the maximum commission rates that this company pays with the product you are recommending compared to the major mutuals. And a super important piece here is to ask to see products that are designed for cash accumulation. On to step 4, choose the right time. The most successful people I've worked with have all had one thing in common when they started their first policy. They either had a ton of cash on hand or they were already saving money consistently. They did not try to build savings the same time they started the policy, meaning they didn't try to force it. If you take a policy that is set up with as much cash value as possible, there's still some drawbacks. So let's go back to the example we talked about earlier, and we'll assume you know how to get option C, which is the good policy. So you're gonna put $10K per year into a whole life insurance policy. And we wanna look at the cash value year over year, and I'll show you exactly what the big drawback is here. The first year, you paid in $10K and your cash value was not $10K. Might be $9,000. The second year, you pay in $10K. Your cash value is now $18,000. You pay $10K. Your cash value is now $29,000. And then finally, by the 4th year, you pay $10K again. And now the policy is starting to pick up the pace, and you're at $41,000. If I'm starting a business today and I want to use a policy for business so I can use it like my own line of credit, but I'm in the early stages of my business where it needs every penny it can get until it's really cash flowing, I'm not looking to start a policy. First, I want to get the business healthy, have it really cash flow, and then start a policy. That would be my preference. Infinite banking and whole life insurance can be a great part of a well-diversified strategy, but it's really, really important to get it right at the very beginning. Now that you know how to apply infinite banking, the bigger question is, how does this plug into a real retirement plan? Watch this next video where I lay out how to use life insurance during retirement.